Hello and welcome to Investing Confidential. Well, the CPI data came out on Wednesday, exactly what everyone wanted, right? CPI supposedly was down month on month, year on year. Market was very strong and then faded fast. Okay, what I'm going to discuss today is why the market faded, and could people be actually focusing on the data and not just the headlines? And then I'm going to give you some reasons why there are some bulls out there, and maybe they're right. But all right. So first, let's talk about the data. And this is the kind of data that professionals are going to are focusing on, right? So, and this is obviously why we saw a lot of large institutional selling today after the open. So, and then also some of them look at it and get bullish. But let's look at the data here. So what data we focus on? This is CPI. Here's the release. Okay, I'll show you exactly what we're looking at here. Now, there's a lot of noise and everything else, but the focus should be on, where the outliers are. What's causing the CPI to move? That's what you really have to focus on. And as you see here, it's energy. Okay, energy was the big cause of the CPI down three. Energy was down about 3.5%. It's a massive component. Okay, energy, gasoline, consumer, all of this. It's a very, very big component. And this is what the talking heads they weren't focusing on energy. They were focused on other things. All the writers, the pundits, they were all waving the flag. Oh, CPI's down. They were all focused on the headline number, not the data. They're saying that inflation is defeated. The White House is raising the flag. Everyone's excited, but they're not looking closely at the numbers, because what you see here is since the end of December, crude has rallied. Okay, look at the chart. Okay, crude oil futures, they're spiking. Okay, OPEC made that decision to cut production. Boom. If you'd watched my videos a few weeks ago, I told you oil's about to explode. I didn't think OPEC was, but it didn't matter. Oil was down for artificial reasons. Okay, as you can realize, they're not showing you the data anymore on the strategic oil reserve because they've depleted to nothing. They've depleted it to nothing. And then they tell you they're going to buy it back in 70. That's the bottom of the oil market. Okay. So that's it. The White House made a strategic error, just like the Fed's making errors. Everyone's making errors, and oil spiking. Okay. And here, now you have gasoline prices also spiking. Okay. This is not good for the CPI. The next CPI is going to be affected by this. Okay. Then you got things like sugar, which I spoke about yesterday. Here's sugar again. Then you also got soybeans and other things. No one's paying attention to these things because they're focused on these artificial headline numbers, which mean nothing. Okay. But the professionals are watching. Okay. And the real issue affecting stocks, so this is what the big guys are focused on. This is I was focused on, and I would be focused on, is the economy. Okay. And the banking system. Not that the banking system is in problems, but the banking system as a business. Okay. And as I said, there's no issue with the banking system. The U.S. government is backstopping all deposits. So as an individual deposit holder, you should not worry. Put your money in any bank. Put it in Credit Suisse. Put it in a small bank. It doesn't matter. U.S. government's backstopping everything. So don't worry about the banking system. The issue with the banking system, with the banks in general, is profitability. Okay. And future issues like insurance companies. Okay. And as we spoke about, I'm going to say it again. UK pension fund was the canary in the coal mine. Then we had this issue with Silicon Valley Bank. Every bank made the same errors. They didn't listen to what was really going on. They listened to the White House. They listened to people like Powell and Yellen, who told you inflation was transitory. They didn't hedge their positions, and they got buried. And in fact, every insurance company, okay, has positioned these long-term bonds at zero interest rates for years. Okay, probably every insurance company, if you mark to market, they're all insolvent. They're all insolvent. Okay, but they're not going bust. If you're a holder, you're not gonna lose any money. But the one thing the government's doing, which is sort of the right thing, is they're protecting depositors, and they will protect insurance holders. And I'm telling you, watch for the big insurance headline coming. But shareholders are going to go zero. So as a stock, and this is a stock market video. So as a stock market shareholder, you should be concerned only because It's affecting the business itself, not depositors, but the business itself. And here's what's affecting the financial sector. Okay, first thing, money market funds, they're exploding. Banks do not make any money on money market funds. They offer it to you, boom, but they receive no benefit. They don't get the float. If you deposit money in a CD or anything else of that nature, they get the float. Okay, large banks don't care. They don't offer very, very high yields. Okay, they know that people are coming to them because it's safe, whatever. And but they have to start raising their deposit rates and SCD rates because of this explosion in money market rates. So the profitability, the net interest margin, the NIM as they call it, NIM profitability is going down, and you're going to see this across the board over the next few quarters. Just the beginning. Okay, now as banks also have historically made money in real estate and construction. This is the basic business of banks. Okay, if you ever watched The Wonderful Life with Jimmy Stewart, the old building and loan, that's traditional banking. You take in deposits, you keep the majority of it in safe instruments, and you lend out the money. That's how banks make money. Okay, the U.S., as you can see here, is the most heavily exposed to the real estate and construction industry in the world, or we call commercial real estate, but that's essentially real estate and construction. Okay, the U.S. is heavily exposed, and who's exposed the most? It's regional banks, not the big banks. It's the regional banks. And they got a big problem because this is obvious. But since COVID, since the new world of working, vacancy rates are exploding. And this is just the beginning. I can tell you, I've traveled a number of places in the last month around the world. Everyone is remote working, everywhere. Okay, vacancy rates are exploding everywhere. In Midtown Manhattan, it's got to be 50% plus vacancy rates. They won't tell you that, but I can tell you, if you go to Midtown Manhattan today, where what used to be the new financial district, there's nobody around. There's nobody around. All the delis are closed, and they tell you New York is booming. Bull crap. Okay, vacancy rates are exploding. Even multifamily. Okay, again, talk about bank investing, lending to multifamily construction, and all these. This is where all the investment, the REITs are all invested in multifamily. Everyone's piling money. Oh, people are going to rent. Again, this whole idea of let them rent. Okay, nobody wants you to buy a house. Let Blackstone buy the house. You rent. Okay, the so-called experts, boom, they're getting crushed. This is where they told you invest. They're getting crushed. And what does that say about the economy? Okay, when multifamily housing is being imploding, where are all those renters? Okay, what does it say about the economy? It tells you the economy is very sick. Okay, and then what happens when banks are having problems with real estate in their core business? They just decide to restrict lending. They don't lend anymore, and they dump assets. Here they're dumping, as you can see here, MBS, mortgage-backed securities. They're dumping them out of the portfolio. They got no choice. They're taking massive hits. They're taking massive losses. Boom, they're out, and they stop lending. Okay, and if they stop lending to construction, what does that mean? Layoffs, because construction is the number one supplier of jobs in America. Construction, boom, layoffs. And what does it happen? The consumer gets hit hard. We've talked about it before. The stock market, it's all about earnings. It's all about the consumer. First quarter is already anticipated to be very weak. Okay, the Fed is going to pivot at some point very soon. I'm telling you, because of this whole banking thing, they're being forced. And it may be a short-term positive, but it won't hold. Another bear market rally is coming. Okay, U.S. valuations are pointing, as you can see here, to lower return expectations. Okay, when you have very high valuations over a period of time, over time, your return expectations are significantly lower, 0 to negative. Okay, on stocks. Okay, and here we go. Again, earnings. Here's positive guidance. The number of people talking about positive guidance is going down, shrinking heavily. And here's negative guidance. Negative guidance you don't want to see. Negative guidance going up. So positive guidance going down, negative earnings guidance going up. What does that tell you? This trend is terrible, absolutely terrible. And here's another thing: professional investors, hedge funds, etc. Nobody is short. Okay, you can thank Wall Street Bets and all these guys, that they squeezed all the shorts out a few years ago. They blew them up. They all became long onlys now. And this is dangerous because hedge funds created a good ecosystem. When they're short, when the markets go down, they have to buy and cover. They create liquidity. Okay, now there are no buyers on the way down. There's nothing. Okay, we may get an 87 whoosh at some point very soon. There's no liquidity. Okay, absolutely no liquidity. And again, here we go. We have been in a bear market rally, as you see in the chart. Market's trended high. It's very choppy, but it's trended higher. Okay, so I told you I was going to give you something for the bulls. Here's something for the bulls. Here's something interesting. This is kind of obvious, but stocks do very well after pessimism fades. This is human nature. So we have a lot of pessimism. Everyone gets negative. Everyone gets bearish. Stocks bottom, and then as soon as they bottom, boom, we start to get really good returns. But we're not there yet. Not everyone's. There's still a lot of bullish people around. So we're not there yet. But this is something to watch out for, and something could happen. I think it'll be a bear market rally, but something will happen. So here's bullish. Okay, and then the second thing is, here's this bullish theory, not my theory, that after a 7% gain in the first quarter of the year, going back 100 years, stocks have a good quarter. Okay, the thinking is good, but the problem is that if you look at this data here, the number is actually 8%, not 7%. Okay, so this is the only time that we've seen a below 8% in a quarter, and we don't know if there's going to be. It's not apples to apples, but it's something to think about. So there's some good news behind the bad news in terms of the stock market. But the bottom line is the stock market couldn't hold the gains after what was considered a very good CPI report. Okay, it's all about the economy. It's all about earnings. And because the economy is weak and going to get much weaker, and earnings, this is the beginning of a downtrend in earnings. If you're an investor, you have to be careful out there.